All right, so Joe, I want to buy a house. I have the credit, I have the income, but I don't have cash in my bank beyond what I'm going to need for my inspection, my appraisal, and my moving costs. What can I do?
Well, Devin, one option that we can definitely look into is FHA financing, which usually carries a 3.5% down payment. Mm-hmm. However, there is down payment assistance options available.
Down payment assistance.
Yeah, exactly. So one of those, it used to be called the River City program. Mm-hmm. So there's funds that are attached to these cities. We were just talking about
absolutely this. It's called Covington funds. It's called the consortium program. It's called River Cities. It's called a lot of different things, but it's a really cool kind of grant program. It's a modified grant in that you can qualify for 10. That is a forgivable loan. So basically, if you live there for 5 years, a percentage is forgiven every year until it becomes essentially a grant. If you move under 5 years, then you have to repay a percentage based on how many years you live there. Yeah. And I have done over 80 of these. I don't know exactly how many, but I've done over 80 of these over the years. And it's really a great program. It covers Covington, Newport, Dayton, Bellevue, Ludlow, and now Erlanger and Independence, which is why we can't call it River Cities anymore, because those are not River Cities. But basically, somebody is approved for a loan, all right? They've talked to Joe.
Sure.
Or whatever other lender, but you should talk to Joe. And they've gotten their approval. And they come in and they say, hey, I need this down payment assistance. We're in these cities. Basically, here's the deal. They do follow a little bit different guideline on the condition and the inspection that they do, because they do their own inspection. And it's essentially the same as Section 8 is what it is. But John, the guy who runs the program through Covington, is really fantastic. He knows exactly what he's doing. He'll walk into the house. He does his inspection. He does his own application with you. And then they have a class that you can take. It's like an hour and a half, I believe. And you can take it online, a first-time homebuyer type education class. You meet these requirements. You do a separate closing with him before you're going to close on the house regularly. Yes. And he's going to sign the paperwork and give you a check that you then bring to closing for your down payment money. Now, here's the beautiful thing. $10,000, Joe.
$10,000.
That's not chump change. So if you're looking in these areas, a lot of times, if you've got FHA loan, even a 3% conventional loan, which is doable,
right,
that could cover your down payment, and in some cases, the majority of your closing costs.
It's true.
Which means you're moving in very, very low money out of pocket.
If you're shopping for a $200,000 house, just fairly reasonable. Mm-hmm. I mean, that's,
Covington, Newport especially.
Exactly. There's lots out there.
Independent, you're probably not going to find anything for $200,000. I'm just going to put that out there right now.
Very little, if not, yes, I tend to agree.
It's not impossible, but it's close to impossible.
Right. But think 3.5% of 200,000 is 7,000. Mm-hmm. That leaves you 3,000 left for closing costs. Which one thing we wanted to talk about also is seller concessions here. Mm-hmm. So what usually happens with seller concessions, in my opinion, I'd love to hear yours as well. A lot of the times, it's basically like you're financing in the closing costs. Mm-hmm. Because if you're going to buy a house for $200,000 and you got $5,000 in closing costs, then you say, hey, we'll buy the house for $205,000. We want you to pay $5,000 in closing costs. Mm-hmm. You're still getting your full amount. Mm-hmm. My loan amount just went up. As the buyer, your loan amount goes up. You'll pay a little bit extra every month, but it beats the heck out of dropping $5,000 out of your pocket.
Right.
So when we're talking about this program, mm-hmm. you're shopping for a $200,000 house. Down payment 3.5%, $7,000. Mm-hmm. That leaves you $3,000 left to cover closing costs. Instead of asking for that $5,000 in closing costs, you can now say, we'd like to do a $202,000 loan, or $202,000 purchase price, and instead, a lot of that closing cost is covered by this grant.
Mm-hmm. Absolutely. Or you use that $3,000 and maybe you have some money, and so you give them their asking price,
sure.
Or you give them the $202 and give them a little incentive in a competitive market, go just a little over, and you pay that difference. But there's a big difference in having to come up with $2,000 or $3,000 versus having to come up with $5,000 or $10,000 for closing costs and down payment.
Absolutely.
So what it does is it gives us flexibility in negotiating the best deal for you. Now again, there's some extra steps if you're going to use this funds program, this grant program, that we're going to have to go through and connect you with, again, the people who do it. And there is an income cap on that program. I do not know what that is, but I know that it is not super, super high. So if you're a high income earner, this is not going to be the program for you. This is really designed to help people, first time home buyers, lower income buyers, people that want to buy a home that otherwise wouldn't qualify. Again, I've done many of these, and the only times I've ever had a problem is if somebody runs into, they said they made a certain amount, but when the income's actually verified, they made more.
Right.
Or condition of the house, where we then are probably going to run into the same thing, FHA, VA, or ECA isn't going to count in this case, where we're going to have to ask for certain things to be repaired.
Sure.
Because they need to be updated, they need to be addressed. But here's the good news. If that program does not work for you, we can still ask for seller concessions, which I would say at least 7 out of 10 buyers that I work with, we get some amount of seller concessions.
Yes.
Sometimes I don't get all of it. Sometimes you still have to pay a little bit of money. But if we're writing competitive offers, and there are other things to negotiate other than price, folks, most of the time I can get you some seller concessions. It's going to save you money. But then there's also the FHA down payment assistance program.
The FHA Down Payment Assistance Program. This is true. So with the FHA Down Payment Assistance Program, usually it's 3.5% down. It's got income limits just similarly to this program as well. Usually it's based off, and I believe this other program was also based off of the median income of that county.
Yes.
Right? So,
which is generally more than what the Covington program. It is lower. It is lower. So, more people qualify for Kentucky housing is what it's called. But a lot of people use it with an FHA loan, a 3.5% loan. And then what's going to happen, Joe, is if they get the Kentucky housing down payment assistance, then their loan is actually going to become a Kentucky housing loan.
Right.
So no matter what kind of loan you're using, Kentucky Housing is going to buy that loan because they're going to own the down payment assistance, which is a loan as well. We want to be clear.
Yes.
They're giving you the $10,000, but you are actually going to repay that as a separate payment from your mortgage payment, all right, at a very low interest. So I used the Kentucky Housing Down Payment Assistance when I bought my home in 2015, before I was in real estate. I moved here. I had a job. I had income. My wife had income, but we moved here. We didn't got no money because we were moving.
Sure.
All right. So we found a house, beautiful house, lovely house, and in Covington, Fort Mitchell area, South Covington, for those of you that know the area. And again, we were moving. We were temporarily living someplace because I had already started my job. I didn't really know the area. So we're looking around for about 3 months. So I used Kentucky Housing Down Payment Assistance to fund the down payment. All right. And then we had seller concessions as well. So I got both, just like I'm saying I would work for you. And when we closed, basically I got 2 mortgage payment booklets. And yes, we set it all up online, but you still get mortgage payment booklets.
Right.
All right. So the first one, Kentucky Housing Down Payment Assistance, it was like $95 at that point. I don't know. It might be a little bit more. I'm not entirely sure because they actually give you more money now than they did when I bought my home. But it was $95 a month. We paid separately than we paid our mortgage. All right. But here's the thing is there's no prepayment penalty. So we actually paid that off early. We paid it off in the first year.
Nice.
Versus having that. Otherwise, you pay it off in about 5 years. It's a 5-year repayable loan program.
Well, I'm glad you mentioned that also, because there is one caveat to down payment assistance programs, is that if you refinance, specifically with the River City, right? Not River Cities anymore because Erlanger and Independence are in there as well. Mm-hmm. But we were talking about where if you move within 5 years, you pay that back at a prorated amount. Mm-hmm. It's similar with down payment assistance programs if you refinance.
Yes.
So if you refinance, which we expect lots of refinances in the next 2 years.
Most likely.
Right. 24, 25, 26, we're supposed to see some better rates. We're supposed to see rate cuts this year. Mm-hmm. If you refinance, then you have to pay that back.
Yes.
Unfortunately.
Also, if you move before the 5 years are up, then again, you have to repay a portion of that. I have some clients now that they bought 6 years ago, and they specifically waited until they had repaid it all so that they didn't have to repay that from their pro. So again, there are some different rules. There are some different things that have to be looked at. That's what the lender is here for.
Absolutely.
I'm just here to tell you that there are options. But the good news is, Joe, there are options.
Absolutely, there are options. Knowing your options, recognizing the situation, and knowing your options is the biggest part of the battle.
So if you need to know more about this, you're like, I don't understand, I don't know what those options might be, reach out to us. Let us know. We are happy to talk to you, to connect with you. Together we can go through this. Here's the buying process, here's the lending process, and walk you through step by step. The good news is we do this every day.
Every day.
So sometimes there are things that we're like, we don't know about that. We're going to have to find out and get back to you. But for the most part, we know what this process looks like. We know how it's going to work, and we know how we can help you. But every situation is different. Sometimes we have to look in specific areas, right? I've had people that, that you only qualify for a USDA loan right now because you don't have any money, and you don't qualify for the down payment assistance because there is a credit requirement for Kentucky housing as well. So every person's situation can be unique and specific, but we know how to navigate that. And we know what options are going to be able to work for you once we get into those situations. So reach out, let us know. We're happy to talk.
I'd love to. Yeah. Guys, owning your home is really the first step for the vast majority of people for financial freedom.
Absolutely.
Let's get you in one.
Joe, you mentioned this comment earlier when we were talking before we were recording videos. You said that the average wealth or net income, or I can't remember how you said it.
So
but this was striking to me.
So the average net worth of a homeowner in the United States is just over $200,000. The average net worth of someone who rents in the United States is just under $10,000. Now, there's specific extremes on that end, right? Unfortunately, our really top dog heavy hitters are all homeowners. So that might skew things a little bit, but the bottom line is, guys, owning a home is going to set you up for more success down the line than throwing your money away on rent. Mm-hmm. So, and there's options to get you in.
And I can tell you anecdotally that is true. I use NerdWallet just as a thing to kind of help me track my own financial picture myself. And my net worth before I plugged in the equity from my home was right in the range of between 10 and 20. I was like, I'm feeling good. When I plugged in the equity of my home, it went up exponentially. Now, again, equity is something that you can pull from, but it's not necessarily liquid. So we're not saying that you just got $200,000 to go run around and spend.
No.
But it gives you flexibility. And in this world, in this market, with inflation, with all the stuff that's going on, you want to be in the best financial position that you can be. And owning a home is going to help put you there.
Absolutely.
Almost every single time.
I don't know anybody that would disagree with that.
Almost every single time. Now, I will give you one caveat before we go. If you know you're not going to stay in the area for more than a year or two, or, you're like, I'm married now, but they don't know it, but I'm not planning on staying married, things like that, then honestly, renting may be your best situation.
Sure. In
a short-term situation. I'm gonna flat out tell you that. There are times when renting can make the most sense if you know you're gonna be transient. But if you know, I'm planning on staying here, I wanna build a life.
Yeah.
You're not gonna go wrong with home ownership. Historically, you cannot find a time in United States history where that will prove to be untrue. It's true all the time.
There's been 7 times in the United States history when the value of homes have gone down. Aside from that, it's been nothing but appreciation.
And every time they've gone down, what has happened after they've gone down?
The pendulum always swings back.
Right. So even the '08 crash, my gosh, houses lost value. I bought my first house. Well, technically my wife did because we weren't married at the time. So she bought it. It was her condo. I moved into it though before we got married. We bought it in '08. Right before the crash.
Yeah.
Okay. I changed jobs 2 months after we were married. We lived in that condo. I lived in it for 4 months. She lived in it for 2 months. We changed jobs. We moved. We couldn't sell the condo right away because the crash happened.
Right.
Our condo that we bought in the beginning of the year was worth less later in the year.
We owed on it.
But you know what we did? We rented that condo, had income from it while we were in another area for 7 or 8 years, I think.
Yeah.
And when we did finally sell it, We sold it. We got a cash offer, $10,000 over our asking price, the first hour that it went on the market. Not even 2020. We're talking 2018. So the market was good, but not like it's been the last few years. 2018, cash offer, $10,000 over, first hour, and we sold it for $50,000 more than we bought it for. So even though we experienced that, oh, it went down and we can't do anything, we rented it. We ended up making money off of it as an income producing property for years and still sold it for an incredible, incredible profit. That's real estate, folks. That's real estate. And if you want that to be your story, hopefully without the pendulum swing.
Without the big swing. Yeah.
But even so, you just wait it out.
Yeah.
We can help you.
Yeah.
Give us
Absolutely
a call.
We can, guys.
Devin Croner, Coldwell Banker, 859-962-7978.
Joe Vandenberg at 513-907-2530.
We look forward to helping you.